All right. So in this lecture, we are going to start IAS 19 employee benefits, and this is a new standard for you because you have not done this standard in the financial reporting or F7 exam. So when it comes to the SPR, this is very important standard and the easy one as well. You can easily understand this standard, all the examples or the workings, and we'll be doing the exam questions as well. In this lecture, we'll be doing the part one of employee benefits, and in the next lecture, we'll be completing it because I want to take this lecture from the very start because it's something new for you. So, the first thing is what is actually the employee benefits? So, employee benefits is actually the all forms of consideration given by an entity in exchange for service rendered by employees or for the termination of the employment. That means the employees are giving the services to the organization, and in exchange, the organization is giving something to them, which is the consideration, and that consideration is known as the employee benefits. So here it is written all forms of consideration. And now, if you talk about the remuneration, or for example, let's specifically talk about the director's remuneration or the remuneration of the senior management. When you talk about the director remuneration or the remuneration of the senior management. So it has mainly five components. It has the salary, it has the bonus, it has the benefits, it has the share options, it has the pension. So when you talk about the director remuneration, basically there are five components in it. Now, why I am actually discussing this thing in the IS 19 because there is actually an idea behind that. Now, this salary and the bonus thing and the benefit as well. Now, this is something you can say that these are the short-term benefits. Why we call these as short-term benefits? Now, salary is for the month or for the year. The bonus is again the bonus based on the year-end revenue, based on the year profits, based on the year-end total assets. Benefits are given according to the sale. For example, the benefit of the car, the benefit of the medical, home allowance, and things like that. And then you have the pension, which is actually a post-employment benefit. And usually salary, bonus, these two are the cash-based benefits. And short-term because these are for the 12 months. The pensions is actually the post-employment benefit. Now, why the entity would be offering provident funds, pensions to the employees? Because they want to give them a flavor of ownership. Like when you stay in the company, this company is yours. You work for years over here, and when you retire, you will be getting a significant amount from the company so that you can spend rest of your life in a good way. Now, if I'm working in a company and I know whatever I'm getting is for today, and by the end of my employment, I'll be getting nothing, and then I have to start my new life, I have to look for another job, I will never feel motivated. So that means pension is actually the part of the benefit the company offers to the employees because by offering this benefit, they are giving them a confidence that you stay in this company for as many years as you can because whenever you retire, whenever your employment ends, you will be getting a significant amount from the company from which you can spend your life in a good way rest of the life. But we'll not be discussing these share options over here because it has a separate standard which is IFRS 2, known as the share-based payment. Again, this standard will be new for you, and it's not in the F7 exam. But the rest of the thing, the salary, the bonus, the benefits, the pension, the post-employment benefit, we will be discussing here in this standard. So employee benefits is all form of consideration given by an entity in exchange for service rendered by employees or for the termination of the employment. Now you see this diagram, the person who is actually sitting on the chair and reading a book or file, whatever you call it, is actually the employer where you are working. An employee is the person who is working. So employee is actually giving the services to the employer, and in exchange, the employer is paying the benefit, which is the salary, bonus, all those things. So employer is getting the benefit from the employee. Employee is working for the employer. Employee is working and giving the benefit of the company. With the services of the employee, the company is earning something, that is the revenue for the company. And for those services, for the benefit they have earned from that employee, they have to give the benefits in terms of salary, bonus, pensions, etc. So that means that will be an expense for the company. So this thing, whatever the employer is paying in terms of consideration to the employee, is actually the expense for the company. And the benefit which the employee is given to the company is actually the revenue for the entity, because obviously they are working, and due to that benefit, the company is earning something. Now, this is a pure application of the matching concept or the matching principle. Now, if you are recording the revenue which you have earned from those employees in this year, you will be recording the expense of this year as well. Income and expenses should be matched. Income and expenses should be matched. So the main objective of IAS 19 is to prescribe the accounting and disclosure, a liability when an employee has provided the service in exchange for the employee benefits to be paid in the future, an expense when the entity consumes the economic benefit. Now, this is a simple double entry of recording the wages and salaries. Like, you have studied this thing in your basic accounting paper. Like, when the entity is supposed to pay the wages and salaries, so what is going to be the double entry? The double entry is going to be profit or loss debit. That means we are recording the expense, and wages and salaries payable credit. When they pay this thing, they de-recognize the liability, so wages and salaries payable debit, because now they have actually fulfilled their obligation, and the bank credit. So this is a simple double entry which you studied in your basic accounting paper. So a liability when an employee has provided the service and now you have to pay them. So it's the liability for the company, and because the company is paying for this thing, so it's an expense that should be recorded in the statement of profit or loss. So this IAS 19 is actually the demonstration of the matching principle, because you are recording the income which you have earned from those employees. You will be recording the relevant expense as well, which you are paying in terms of benefits to them, whether it is wages or salaries. Sorry, wages, salaries. All right, moving further. Now, employee benefits has actually divided the benefits into four categories. The short-term benefits, which you can, understand from the name, which is related to the current 12 months. The post-employment benefits, which will be given after the employment when the employee retires or when the employment ends. And then you have other long-term benefits, and then the termination benefits. So these are the four categories which the IAS 19 has made. And why they have made the categories? Because the accounting for all these four is different. First of all, wages and salaries and social security contributions, like we have discussed in the previous slides, that the salary bonus benefit is actually a short-term benefit. Similarly, paid annual leave and paid sick leaves, profit sharing and bonuses, non-monetary benefits such as medical care, housing, cards, and free and subsidized goods or services. These are the short-term benefits which the employee consumes within 12 months. Then you have the post-employment benefits. In the post-employment benefit, you have the retirement benefits. Now, retirement benefit, when you retire, you will be getting the pension from the company or a lump sum payment. Other post-employment benefits such as life insurance, post-employment medical care, like you were the employee of the company and now your employment has ended, but still you can do your medical expenses on behalf of the company and the company will be paying for that. Again, this is a post-employment benefit. Still, you are getting that benefit from the company or the life insurance. Other long-term benefits such as long-term absences, such as long service leave, sabbatical leave. Like sabbatical leave means you are actually not going to the offices, you are not working, but you are getting the pays. Like for example, you are getting a 2-year long leave, you are not going to offices, but you are getting the pay. Long-term disability benefits, jubilee or other long-term benefits. And then you have the termination benefits. Terminated employees employment before the normal retirement day. Like for example, if an employee is going to retire after 5 years and the company says, if you leave now, we'll be giving you this much amount in the lump sum. Sometimes here we call it as, golden handshake. Like because they want to bring new people, they want to bring the young blood, and those people are actually near to their retirement age, and the company has actually contracted them that you can work here, for example, up to the age of the 60 years. But now they are at 55 and the company wants to bring new people. So the company says to them, if you leave earlier, we'll be giving you this much amount. Or for example, sometimes you are paying the directors, which in the corporate governance we call it as reward for failure. Like say for example, there was a director who was appointed for a 3-year term and he is actually an underperforming director. He is not doing well in the company. Now the shareholders want this director to be removed from the board. And they say you can leave. He say, okay, if you want me to leave, you have to pay me this much amount because my term was for 3 years, because you are asking me to leave earlier. By contract, you have to pay me this much amount. So that will be the termination benefit, which the employee will be getting, and ultimately it is going to be an expense for the company. So the employee benefits is actually divided into four categories. You have the short-term benefits, you have the post-employment benefits, you have the other long-term benefits, and you have the termination benefits. And these four have a different accounting treatment, and we will be discussing that in IAS 19. Now, first of all, the short-term benefits. As I said, the word short-term is actually which is for the 12 months. We use short-term word in accounting, which is for 12 months. So employee benefits that are expected to be settled before 12 months or within 12 months after the end of the annual reporting period in which employee rendered the related service. Like this, these things are related to the short term for 12 months, like salary, bonus, benefits. Short term employee benefits are recognized as a liability and an expense, as I told you, with whatever you are talking about, whether it is salary, whether it is bonus, whether it is benefit. So debit profit or loss, that means you book the expense in the statement of profit or loss, and you credit the short-term benefit payable. Now, short-term benefit payable means you can fit anything in the short term according to the name. For example, salary payable, bonus payable, benefit payable, whatever it is. So it is going to be a liability for the company. And remember, because this thing settles within 12 months, that is why we do not apply the concept of discounting over here, but this is going to be applied in the long-term liabilities. Because you have studied in the financial management that we are not going to discount it because it is going to be settled within 12 months. So no discounting. No discounting means we are not going to bring this to the present value. So the short-term benefits. And then you have one more thing in it, which is very important, short-term absences. Now, probably you guys are working somewhere, or if you are not working somewhere, you probably have heard from your friends who are working, who are, working professionals, that they have a contracted paid leaves. They have the contracted paid leaves in their employment contract. Like say, for example, 30 leaves a year or 20, whatever the policy is, 33, sometimes 40, sometimes 20. Every company has a different policy. So like, for example, you are having the 30 or 24. Let's take a round figure. For example, 24. Now, 24 is actually is making a sense like you are having 2 paid leaves per month, and in the year we are having 24 paid leaves. If you have done 24 off days, you have taken 24 off days in the year, you will be still getting the salary. You will be still getting the salary because those are paid leaves. So you have a right because this is something written in the contract. For example, the 2 leaves per month. So if you are staying absent for 2 days in a month, you'll be getting the full salary because those are paid leaves. Now, every company has a different policy. Now, the company where I was working 6 to 7 years back, they were having no carry forward option. Like I was having the 24 leaves, for example, and I was supposed to take the leaves. And if I'm not taking it, they'll not be paying me for it. Even those leaves will not be carried forward to the next year. That means it cannot be accumulated. You have to do that in that current year. Now, they were having a logic for that, and which seems quite right to me, according to the management principles. They were saying that when you are working, you are a human. Humans get exhausted sometimes. So you need a family trip, you need to go somewhere, hang out somewhere. So if the entity is giving you the leaves, you should, uh, capitalize that thing. You should accept it. You should enjoy those vacations. And there is another reason behind that. You probably have studied in your management paper that they actually want people to go because if they are doing some frauds, when they give on the leaves, that will be detected. Because usually the people who are doing frauds, they are very punctual because they do not want to miss even a single day, because if they miss a day, someone will be taking care of their work and they will probably detect that. And when I was working in a company before this company, which I gave you in the example, the first company probably, yeah, not the first employer, but in terms of company it was. Uh, they were having the leave encashments. Now, leave encashment policy was like if you are not doing those off days, then the company will be paying you for that. For example, if the salary of the employee is $3,000 per month, so $3,000 divide by 30, it gives you $100 per day. So say for example, if the employee has saved 20 days, they were supposed to do 30 days off. They only did 10, and now they have 20 leaves which they have not used. So the company will be paying 20 into $100 to them. This is the leave encashment. And another policy was, no, not in that company, but some employers have that. Most of the employers have that. Uh, that if you have some unused working days, then you can, carry forward that. That will be accumulated in the next year. Now, why I have told you this big story? Because the treatment is different for these type of options. Sometimes an entity pay employees for absence for various reasons. These include holidays, sickness, maternity leave, etc. And entitlement to paid absences fall into two categories. The one is accumulating, that if you have unused, then that will be carried forward to the next year, and non-accumulating, that means it will not be carried forward to the next year. So carry forward for use in future periods if the current period entitlement is not used in full. That means you have some unused holidays. Expense and liability is recognized when employee renders service that increases their entitlement to the future paid absences. Now, if the company is offering the paid leaves and the employee has not used it, and that will be carried forward to the next year, the company should record the expense and the liability. Why? Why they should record the expense and the liability? Because the employee was supposed to work less in this year by taking the paid leaves, but they have not taken it. So this year they have provided more benefit to the company, and in the next year they will be taking those leaves, and in the next year they will be providing less benefit to the company. So that means the company should record the expense and the liability. We'll be doing two examples in order to understand this concept. So measured at the additional amount expected to be paid as a result of the unused entitlement that is accumulated at the end of the reporting period. Remember this thing, if they have unused holidays, the company should record the expense and the liability. And again, how they're going to calculate it? How they can calculate it by using their salary, monthly salary, and divide by per day and things like that. We'll be doing two examples. The non-accumulating, which will not be carried forward, expense and liability is recognized when the absences occur, like if they are, taking leaves. This may arise, for example, where an employee continues to receive their normal remuneration whilst being absent due to illness and other permitted reasons. Like I have been given the paid leaves and I'm utilizing that. Now let's take the example. This is example number 1, short-term benefits. Okay, the example, first of all, Playman has 100 employees. Each is entitled to 5 working days of paid sick leave for each year. So remember, 5 leaves paid. An unused sick leave can be carried forward for 1 year. Sick leave is taken on a LIFO basis. That means first out, First of all, you have to use the current year and then you can use the previous ones. As at 31st December 2008, which is the year end, the average unused entitlement is 2 days per employee. That means they have taken, uh, they were having the 5, they have utilized 3, and 2 is actually unused. They have taken 3. Playman company expects, based on the past experience, which is expected to continue, this is their best estimate, that 92 employees will take 5 days of feared sick leave in 2009, and the remaining 8 employees will take an average of 6.5 days each. Again, based on the past experience, 92 employees will take 5 days or fear sick leave in 2009. That means even less than what they are supposed to take. And remaining 8 employees will take an average of 6.5 days each. Required, state the required accounting for sick leave. Now, these 92 are going normal, but the rest of the 8, they will be taking 6.5. That means more than 5. So 6.5 means more than 5. Multiply by 1.5. It gives you 12 days. So Playman Company expects to pay additional 12 days of sick pay as a result of the unused entitlement. That is 1.5 multiplied by 8. Playman Company should recognize a liability equal to 12 days. Now, whatever the per day rate is, you multiply it and then you get the total expense, which should be recognized as an expense and the liability. Next example. Example number 2, short-term benefits. Again, so many figures in the question, so you need to be attentive. The salaried employees of an entity are entitled to 20 days paid leave each year. So they are maximum 20. The entitlement accrues evenly over the year, and unused leave may be carried forward for 1 year. They can accumulate it for the next year. The holiday year is the same as the financial year. That means the year end is same. At 31st December 2004, the entity had 2,200 salaried employees, and the average unused holiday entitlement was 4 days per employee. Now they were having 20, they have actually used 16. The 4 is actually unused per employee, and they have total 2,200 employees. Approximately 6% of the employees leave without taking their entitlement. And there's no cash payment when an employee leaves in respect of the holiday entitlement. So 6% do not take it. That means 94% will be taking that. There are 255 working days in the year, and the total annual salary is 42 million. So 42 million divided by 255. Okay, no adjustment has been made in the financial statement for the above, and there was no opening accrual required for the holiday entitlement required. Discuss with suitable computation how the leave that may be carried forward is treated in the financial statements. So now this is a very simple question. 42 million is the total payroll. You divide it by 255, and then you get per day expense of the company in respect of 2200 employees. 6% will not be taking that, only 94% will be taking that unused benefit. And now you can calculate it simply. How? 42 divide by 255 multiply by 94% multiply by 4 days. So it gives you the total expense, which should be recognized as an expense and the liability. So the calculation is simple. 42 million divide by 255, it gives you the per day expense of the company, multiply by 4, which is the paid leaves, multiply by 94% because 6% will not be taking that. Look at the explanation and you will get the idea which I told you before. Why we are recording this expense and the liability? Because the employees were supposed to work less because they were assumed to use their paid holidays, but they didn't. Now they worked more this year and provided more benefit to the company. Next year, they will be working less because they have unused holidays. So an accrual should be made under IAS 19 employee benefits for the holiday entitlement that can be carried forward to the following year. This is because employees have worked additional days in the current year, generating more benefit to the company, but will work fewer days in the following year, means the next year, when the salary for those days is paid. So an accrual is therefore required to match the cost and revenues and apply the accruals concept. So why we are recording this expense? Because this is the application of the accruals concept. This is the application of the accruals concept. All right. So moving further. Now we have the profit sharing and bonus plans. Again, this profit sharing thing and the bonus thing is coming in the short-term benefit. This is coming in the short-term benefit. All right, the expected cost of profit sharing and the bonus payments must be recognized. When the company should recognize the expense and the liability. When the company should record the expense and the liability. There's a criteria for that. The entity has a present legal or constructive obligation, like they have done the contract. The constructive obligation is that you know that they will be discussing that in IAS 37. Although constructive obligation means like there's a practice of the company now, because of their practice it has become their constructive obligation to make such payments. So the entity has a present or legal or constructive obligation as a result of past event, and the reliable estimate of the obligation can be made, like they know that how much actually they will be earning and how much percentage they're going to apply to that to calculate the profit figure or the bonus figure. A reliable estimate of its legal or constructive obligation under a profit sharing or bonus can be made when the formal terms of the plan contain a formula for determining the amount. Like obviously, when you say the reliable estimate, you should have a technique for calculating the estimated bonus or the profit sharing you will be giving to the employees. The entity determines the amount to be paid before the financial statements are authorized, because otherwise it will become a non-adjusting event. So otherwise it become a non-adjusting event that the evidence will not be available at the year end. And the past practice gives clear evidence. That means they have a routine of the amount of the entity's constructive obligation. They have a practice or they have a routine to do that. All right. Then you have an example again. Example number 3, profit sharing. M company runs a profit sharing under plan which it pays 3% of its net profit for the year to its employees. If none have left during the year, they're talking about the employees. M company estimate that this will be reduced by the staff turnover to 2.5% in 2009. So M company runs a profit sharing and there are 3% net profit to employees. Now they're expecting 2.5%. Which cost should be recognized? Obviously 2.5% because the reliable estimate will be 2.5%. So this was the answer in terms of percentage, and then you multiply it with the estimated figure, and then you can have that figure which should be recorded as an expense and the liability. All right, so these were the short-term benefits. We did 3 examples. Now you have a very, very important concept which we'll be discussing in detail in the next lecture, in the next video. But today we are just, touching it. We are just, having a flavor of that. In the post-employment benefit, there are actually 2 types of pension plans. And when this question come in the exam, they ask you that differentiate between defined contribution and defined benefit. So defined contribution, as the name suggests, that the contributions are defined. Now say for example, like there is actually a plan maintained by the pension funds, and employer and the employee are actually putting their contributions in the plan. Now these plan, actually this plan is something maintained by the company, or for example a service provider is doing that. Now when the employee and the employer put the amount in the plan, this company, what they do, they invest it in different places. For example, they did investment gold, property, and shares and other financial instruments, etc. For example, they make a pool of investments, and then they get an expected rate of return, and that return is actually put in the plan. So defined contribution is that the employer contribution is defined. Sometimes employees putting their contribution as well, but most of the time nowadays, actually there is a fixed amount which is deducted from the salary from the employee. The same amount is contributed by the employer, and that is put in the plan. An employer does not guarantee any amount which will be paid to the employee. Now, whatever this plan produces, that will belong to the employee. That means the only expense of the company is the employer contribution and nothing else. So debit profit or loss, credit contribution payable. The defined benefit plan is completely different from the defined contribution, as the name suggests. Now the defined benefit means the ultimate benefit is defined. Like for example, if the employee is going to retire after 20 years, so the employer tell them that, okay, you will be getting this much amount after 20 years. Now, practically how this is dealt, now obviously an employer is not going to wait for 20 years and then after 20 years, the employee comes says, okay, sir, I'm going to retire, give me this amount, and the employer goes to the bank and see how much money they have, and they withdraw from the bank and they pay to the employee. No, this is not the case. This is the amount which is guaranteed to the employee. And now they will be maintaining a plan, and they will be putting the contributions in it so that after 20 years, this plan reaches this amount. Because this is the best business case. I cannot, pay them without investing. I'll be putting regular contributions in it so that this plan makes exactly the same amount which will be paid to the employee after 20 years. Now again, we cannot do this ourselves. We need some services for that. We'll going to the actuary and we'll be asking them what amount we should pay per month or per year so that this reaches this amount in 20 years. Now that means here employer will be having two responsibilities. The first one is the contribution, which they will be putting in the plan. The second one will be the shortfall. If there is any shortfall, like due to the changes in the interest rates or due to the changes in the rate of returns, there may be some shortfall. The employer will be putting that amount as well. But we'll be discussing these two things in quite detail in the next video. So this was a flavor of the defined contribution and defined benefit. All right, dear students, we are discussing the post-employment benefit plans, and there are two types of the post-employment benefit plans. The first one is the defined contribution plan, as we discussed earlier in the last slide, and the second one is the defined benefit plan. Now let's go back what we discussed earlier in the last slide. We discussed that there are two types of the pension plan. The first one is the defined contribution and the second one is the defined benefit plan. And I gave you a small explanation of these two and we'll be continuing it further along with the accounting treatments. So in the first one, I said that as the name suggests, defined contribution, that means employer will be contributing in the employee's plan, and whatever the plan generates will belong to the employee. An employer will be having no guarantees what the plan generates. So that means employer will be having only one responsibility, which is the regular contribution made into the plan. Employer will be having no other responsibility. So the plan will be maintained by a service provider. Employer will be contributing on behalf of the employee. Employee will be contributing as well, but we are not discussing the treatments of the employee. We are discussing from the employer perspective. Maybe you have a question in the exam which gives you the employee contribution as well, but we are not talking about that contribution. That is actually a reduction or a deduction from the employee salary. We are not talking about that. We are only concerned with the treatment which is related to the employer. So whatever the employee is contributing into the employee's plan is the expense of the company, and that should be booked as a debit entry in the statement of profit and loss. And credit goes to the contribution payable. We'll be discussing this in a while in detail. So remember this thing, that in the defined contribution, employer does not have any responsibility other than the contribution. The only responsibility is the contribution what they are making into the plans, and they will not be guaranteeing any amount to the employer in respect of that. The second one, which is the defined benefit plan, is other than the defined contribution. That makes it very different from the defined contribution. Now the defined benefit, as the name suggests, that the ultimate and the eventual benefit is defined by the employer, and they have guaranteed the amount to be paid to the employer. So what they're going to do, I gave you the example, like say for example, if I'm going to retire in 20 years, the employer will be guaranteeing me the amount which is based on the 20 years, because from now onwards I'll be serving the company, for example, for 20 years. They will be guaranteeing me this amount. If you stay within the company for 20 years, we'll be giving you this much amount, which will be actually based on your salary. So they guaranteed me an amount which will be paid to me after 20 years. So this does not work like for example, after 20 years, I'll be going to the employer, I'll be saying, okay, now the 20 years has ended, now give me some payment, and employer gonna, withdraw the payment from the bank straight away and will be giving to me. No, this is not the case. The amount which will be paid after 20 years, employer will actually be making that amount. So what they're gonna do is, first of all, this is the amount that will be paid after 20 years. This is the guaranteed amount. So right now they will be going to the actuary, and they're going to the service provider, and they say, from now onwards, what amount we put in the plan that after 20 years, it makes this much amount. So actually they know the rate of returns, they know what they are actually earning or nowadays. So they will be telling you, okay, if you have to put this much contribution every year or every month, whatever, then after 20 years, you will be able to make this much amount from the plan. So the employer does not have any intention to earn something out of it. The only thing they are actually making sure is the plan earns exactly the same amount, which will be going to pay to the employee. So now the employer has two responsibilities. The first one is the contribution, which they are making into the plan to make that sum of which will be payable eventually to the employee. And second, if there is any shortfall. Now, why there will be the shortfall? Because sometimes the rate of returns they told you may vary because these are the variable rates. They may vary. So sometimes your investment may fall short, and you have to put some more money in order to make the amount which you are trying to make. So the employer has two responsibilities. The first one is the contribution which will be made to the plan, and the second, if there is any shortfall. But remember this thing that the plan can be in the surplus as well, because obviously it works both ways. Sometimes the plan is in the surplus. We'll be discussing that in a while, because that treatment has been discussed in IAS 19 as well. What if the plan is in the surplus? But most of the times when you are discussing the IAS 19, remember this thing that usually we have the deficits. But there are cases in which you have the surplus as well. We'll be discussing that in IAS 19 as well. Now, getting into more detail, so defined contribution, as the name suggests, that the employer will be contributing into the employee's plan, and the only responsibility is the contribution and nothing else. So there is a description written over here, and I can read for you. An entity pays fixed contribution of 5% of the employee's salary into the pension plan each month. The entity has no obligation outside of these fixed contribution. That means the only responsibility is the contribution. Remember this thing, because I told you in the exam, the examiner may ask you to differentiate between the defined benefit and the defined contribution. So it is quite simple if you just focus on the name itself. Defined contribution means that the only responsibility is related to the contribution, and there is no further responsibility. There will be no guarantees. Defined benefit is completely different from the contribution, because here the benefit is defined. So that means here the particular amount is being guaranteed and they have to make that amount. So they will be having two responsibilities. The first one is the contribution which they are making into the plan for making that amount. And the second thing is the shortfall. If there is any shortfall, they have to put more money into it. So there are two things you should remember when you are talking about the defined benefit. The first one is the plan asset. Now this plan asset is actually the money you are putting into the plans. And then there is an obligation, plan obligation. This is the amount which you are going to pay after certain number of years. So you will be putting the money into the plan so that it generates exactly the same amount which will be given to the employee after a certain number of years. So this is a long-term obligation. This is a long-term obligation. You're talking about 20 years, 30 years, and so on. So remember that we do accounting as at. Like when we are making the statement of financial position, the statement of financial position is prepared as at. When you are talking about the statement of profit or loss, it is for the year ended. But these calculations which we are doing is for 20 years, 30 years, and these are the long-term calculations. So remember that we cannot put the 20-year money at once into the plan, because this is not the idea. The idea is that we'll be putting the regular contributions into the plan so that it makes the money which we are guaranteeing to the employee. So by each year end, we'll be calculating the fair value of plan asset. because these plan assets includes the shares, these are the properties, the gold, whatever diversification they have done. So at each year end, there will be a fair value of the plan asset. And this is the obligation is the amount which we will be paying after certain number of years. And you remember from your earlier papers that when you have the obligation which is more than 12 months, there is a concept of discounting it. You will bring the obligation to the present value, like we did in the IAS 16. There was the dismantling cost. In F7, we did that. Dismantling cost or decommissioning cost, restoration cost, that was to be paid when the contract ends, and you are actually discounting it, you are bringing it to the present value. So similarly over here, the idea is that the plan obligation belongs to the future. So what you're going to do is you calculate the present value of obligations. So by each year end, you will be comparing these two things. You will be comparing the fair value of the plan asset with the present value of the obligation. And this is the concept of the deficit and the surplus. If the fair value of the plan asset is more than the present value of the obligation, it makes sense that this is the surplus case, because your asset is more than your obligation, you are having net assets. And if the present value obligation is more than the fair value of the plan asset, it is the deficit case because you have the net obligations. So this is a quite easy concept if you focus on. So an entity guarantees a particular level of pension benefit to its employees upon retirement. So they are guaranteeing an amount. The annual pension income that employees will receive is based on the following formula: salary at the retirement multiplied by number of years worked divided by 60. An entity has an obligation to pay extra funds into the pension plan to meet the promised level of the benefits, as we discussed in the last slide. So there will be two obligations. The first one is the contribution, and the second one, if there is any shortfall. If the things are going smooth, if the things are going according to the plan, there will be no need to put extra funds into the plan because the plan will generate actually the same amount which you were expecting. But sometimes there is a variability. Sometimes you have to put extra money in order to meet that amount. Okay, now we are actually having a test your understanding. Number one. Actually, I have named the examples. I've numbered the examples and test your understanding. If there is something like different, you can fix it yourself. So this is your test your understanding number one, and the requirement is advise Deller on whether the fund is a defined benefit or a defined contribution. In the exam, you may have a similar question because in the past we have seen that this type of questions are coming in the P2 or the SBR exam. So you have to identify from the case that what do you think whether this plan is a defined benefit or defined contribution. Now remember, defined contribution is the employer putting the amount in the plan and they're only responsible for the contribution, nothing else. Defined benefit, they are guaranteeing an amount. Now let's see whether you are able to identify whether this is a defined benefit or the defined contribution. Deller has a defined contribution pension scheme. However, during the year, it introduced a new post-employment plan, the fund for its employees, as a way of enhancing the benefits they will receive when they retire. So they are good employer. They're focusing on the employees because obviously employees are the one who generates money for the company. Deller makes monthly contributions into the fund that are equal to a set percentage of the salary cost. Now, if you think till here, looks like a defined contribution because they are making contributions into the plan. Upon retirement, employees will receive annual payments from the fund based on their numbers of service and their final salary. From here, it looks defined benefit because we discussed on the last page. The salary at the retirement multiplied by number of years. Okay, looks like a confusing thing. The fund is voluntary and Deller can cancel at any point. Okay, seems they have no obligations as per contract, they can cancel it. Now, again, it looks like a defined contribution. Deller has a history of paying employee benefits that are substantially above the national average, with annual increases in the excess of the inflation. That means they are paying something more than what they are supposed to pay. National averages, they are paying more than the market. They're paying more than what other employers are paying. Deller has won many accolades as employed as a top employer. That means awards, accolades, awards, and received positive coverage from the national press when the fund was announced. The leadership team are well trusted by the employees. Now, if you see from this paragraph, so you will see that there is a past practice of this employer that they have actually paid the employees in excess of the national averages, more than the national averages. And they are actually giving them the increases due to inflation as well. So what do you think? Is it defined contribution or is it defined benefit? Because from the first paragraph, it looks like a defined contribution. From the second paragraph, it looks like a defined benefit. From the third paragraph, again, it looks like a defined contribution because it was voluntary and can be cancelled anytime. But in the fourth paragraph, we saw that actually they have done this thing in the past. That is why they have made a constructive obligation. Constructive obligation means the obligation by themselves. There was no legal obligation, but from their past practice and from their norms, it has been developed that they are paying to the employees in excess of the salaries and national averages. It is possible that there is insufficient funds asset in the fund to pay the benefits due to the retired employees, particularly final salaries or life expectancy rise substantially. Deller therefore bears actuarial and investment risk because if it continues the fund, it would need to make any shortfall. Although the fund is voluntary, Deller has a history of remunerating its employees above the national average. Deller therefore has a constructive obligation to continue the fund and to ensure the level of assets is sufficient. As a result of above, the fund should be accounted for as a defined benefit. Now, why we are accounting this thing as a defined benefit? This is a very good example, and make sure you are understanding it because you may have such question in the exam. So why we are accounting this thing as a defined benefit? The first of all, of the risk, because if anything falls short, Deller will be putting more money in order to meet the employees' expectation and in order to make sure that they are actually getting more than the national averages. So they are putting some more money into the plan as well. So they are bearing the risk. The second thing is, although this was a voluntary plan, but they have the constructive obligation. Constructive obligation means there was no contractual obligation, but they have made the obligation for themselves through their norms and practices. Now, everyone expects that they will be paying something more than the market, and they have won the industry awards as well on this thing. Now, everyone expects this thing from the company, and they will be meeting the employees' expectation. That is why, due to these two factors, this will be accounted for as the defined benefit. This was a very good example. All right, now we'll be discussing the accounting for defined contribution. Already we have discussed it, but we'll be discussing in more detail. Now, the first of all, whatever employer is paying in terms of the contribution is the expense for the company. So debit, profit or loss, because whatever they are paying is the expense of the company. And credit, contribution payable, because once the liability arises, they have to record this as a current liability. Contribution payable. But sometimes when they are actually, now this is the entry of the accruals. This contribution payable is actually the accruals, because accrual expense, do you remember from your F3 paper or the basic accounting exam, accruals and prepayments? Accrued expense means the expense that belongs to current year but not yet paid. And the prepaid expense is that you have actually paid the expense in advance, but that belongs to the next year, not the current year. So sometimes you are actually making payments in advance. Sometimes you may have the case of the prepayments. Sometimes you may have the case of the prepayments. Now, in that case, you have paid in advance. So credit is the bank because you have made the payment. And debit here is actually the contributions made. And we'll treat this as a current asset because you have made the contributions in advance, and that does not belong to the current year. So accounting for defined benefit is the entity should charge the agreed pension contribution to the profit or loss as an employment expense, as we did over here, debit profit or loss. The expense of providing pension in the period is often the same as the amount of the contribution paid, because usually the company pays the same amount. Sometimes there is a concept of accruals or prepayments. If it remains unpaid till the year end, it is accruals. That means, or for example, if they have paid less what they were supposed to pay, like they were supposed to pay 100 and they have paid 80, now the 20 is accrual. Sometimes they pay more than what they were supposed to pay, that will create the prepayment. All right, let's do an example and then you can, this is example number 4. An entity makes contributions to the pension fund of the employees at the rate of 5% of the gross salaries. For convenience, the entity pays 10,000 per month into the pension scheme, with any balance being paid in the first month of the following accounting year. The wages and salaries for 2006 was 2.7 million in total. This is 2.7 million. Now, what they are supposed to pay in terms of contribution is this amount. 2.7 million multiplied by 5%, which means they are supposed to pay 1,35,000 per year in terms of contributions. What they are doing is they are paying 10,000 per month. That means they are making contributions of 1,20,000 per year. Now the contribution paid is 1,20,000, and the contribution payable was 1,35,000. So they have not paid 15,000, and this 15,000 should be recorded as accruals because this belongs to the current year. This is the expense of the current year, but they have not yet paid it. So this 15,000 will be recorded as the accruals. This is the current liability. All right, we have another example, which is example number 5 of the defined contribution. Mouse, a public limited company, agrees to contribute 5% of the employee's total remuneration in the post-employment plan each period. In the year ended 31st December, the company paid total salaries of 10.5 million again. So 10.5 million multiplied by 5%. But there's one thing you need to focus on in this example, which is very important. And I'm going to read it again. Mouse, a public limited company, agrees to contribute 5% of the employee's total remuneration. Total remuneration. In the last question, it was a bit different. In the last question, they were saying 5% of the gross salaries. So in the example number 4, they were only contributing based on the salaries. In the example number 5, they're saying 5% of the total remuneration. Now the remuneration, as we discussed earlier, may have more components in it. So let's see what we have in this question. A bonus of 3 million based on the income for the period was paid to the employees. Now this is the part of the remuneration as well. The company has paid 5,10,000 to the plan. This is what they have paid, the contributions. Required, calculate the total profit or loss. Calculate the total profit or loss expense. We have to calculate the expense for the current year. For post-employment benefits and the accruals. Now, as I told you that in this question you have a different case. They are paying on the total remuneration. So we have two components in this question. We have salaries, we have bonus. And the total of these is 13500 and 000. All right. So it is, so how much it is? It is 13.5 million. Multiply by 5%. So it gives you 6,75,000. This is the amount again. So contribution paid is 5,10,000. Contribution payable is 6,75,000. So they were supposed to pay 6,75,000. They have only paid 5,10,000. So this 1,65,000 should be recorded as accruals. So you see the double entry, debit profit or loss with total expense, credit cash with 5,10,000, and credit accruals 1,65,000, which is actually the current liability. All right, now we have the defined benefit, and we have discussed this thing in quite detail, that what actually you are doing in the defined benefit, that the entity is actually maintaining through the service provider the plan asset. In the plan asset, they are making contributions, and then obviously they are supposed to pay a guaranteed amount to the employees, which is the plan obligation. At each year end, they will look at the fair value of the plan asset, and this will be compared with the present value of the plan obligations. So the objective of the employer is that this plan asset should have sufficient funds to meet the plan obligations. At each year end, they will be comparing these two figures, and this will give rise to the concept of the surplus, which is the rare case, and then deficit. So surplus will be recorded as an asset in the statement of financial position, and deficit will be reported as a liability in the statement of financial position. So this is what actually we will be discussing. So defined benefit plans is other than the defined contribution, because this is completely different. By definition, the definition is a plan which is other than the defined contribution. So what is this actually? Sorry. Typically, a separate plan is established into which the company makes regular payments as advised by an actuary. This fund needs to ensure that it has enough assets to pay future pensions to the pensioners. The entity records the pension plan as an asset and the liability, as I have discussed with you. In its own books, that is, bear the pension plan's risk and benefits. So in substance, if not in the legal form, it owns the assets and the liabilities. So why they are recording? Because these These funds belongs to the employee, but because we are having the risk, so we'll be doing the accounting for it. And then there is a complexity. Obviously, does it looks like a simple thing to you that we'll be putting money and then it will be making return and then we'll be paying to the employees? It looks like too simple when I'm describing it or I'm writing on the screen. But practically, it's a quite difficult thing because obviously there will be many assumptions involved that how many people will be staying, how many people will be getting the benefit, what is actually the age of their retirement, and what are the expected returns. So actually these assumptions may vary, which creates the complexity. So it's not easy as it looks like when I'm describing it to you. In practical, it's a quite difficult thing to achieve. And then obviously when we are doing the calculations, there are certain assumptions, which is actuarial assumptions, and that will be done by the actuary. And you will not be, you are not supposed to calculate that thing in the exam because the assumptions and the figures will be given to you, that how much they are putting into the plan, what is the return they are making, and so on. Otherwise, that this is a complex thing to achieve in practical. So what method they use to calculate these obligations thing, etc., that is known as the project unit credit method. But there's no need to learn this method because in the exam everything will be given. So there's no need to research on this topic because it's a very complex thing. And obviously we may choose to enter into these field, but this is again a completely different field that the actuaries are doing for us, and we are not it involves a lot of algorithms and things like that. So actuarial assumptions are needed to estimate the size of the future benefits that will be payable under a defined benefit scheme. And there will be demographic assumption, for example, mortality rates before and after the retirement, employee turnover, retirement ages. And then there will be final assumption, but there will be final future salaries, final salaries on which we are actually making them the amounts. Like we are making them the payments based on their final salary. So from now and after 20 years, what is going to be their salary? This is again going to be an assumption. So actuarial assumption should be unbiased. That is why the actuary will be making that and will not be making for ourselves. Now the accounting for defined benefit, I have told you this thing. That what we'll be doing in the statement of financial position. Again, let's go back and discuss. We'll be comparing the fair value of the plan assets with the present value of the obligation, and this will give rise to the surplus and the deficit. Surplus is the asset and deficit is going to be the liability. Now there's a working for that, and you will be having a question in the exam, so you just need to see this working and understand this working. Very important working for you. There are many methods of doing this working, and many people are doing with the T accounts. They are maintaining the T account of assets separately and the liability separately. And then there are some people who are doing the statement form and they are making the statements of assets separately and the liability separately. And in the as a result, they do netting off after once they have calculated the both figures. But the method we will be doing is a simple method. Is we are actually doing a net method. In this method, we are actually taking both the assets and liabilities together. So it starts with the opening balance, and what we'll be doing is we opening balance of obligations minus opening balance of the assets. It gives you the positive or the negative figure. If you see here in this working, the positive figure actually represents the deficit. So the plan is in the deficit because usually it is going to be in the deficit. The negative is the rare case, and it shows that the plan is in the surplus. That means assets are more than the obligations. Then there will be net interest component, and there will be the service cost component, contributions into the plan, benefits paid, and it will give you this figure. And then you will be comparing it with the closing balance and the remeasurement component, which is the remeasurement gain or loss, will be calculated as a balancing figure. Now we have to discuss each and every component of this working, and I have made the separate slides for that so that you can understand all these things in quite detail. All right, the first thing we'll be discussing is actually the service component. We'll be discussing the service component. So you have the service cost. In the service cost, we'll be having two components. The first one is the current service cost, and the second one is the past service cost. So the service cost component is divided into the current service cost and the past service cost. This is what we are discussing right now, service component. Now, we are maintaining a plan for the employees. And when they are providing us the services every year, the obligation will be increased as a result. Like for example, they are provided as the service of 1 year, and then second year, and then third year, and then fourth year, fifth year, and so on. When they are providing us the services, the liability is actually increasing day by day, year by year. Every year when they have provided us the services, the obligation will increase as a result, because they have provided us the services, now they are entitled to what they should get. Because in the defined benefit, we told them that you will be getting the payment based on the number of years they have served and based on their final salaries. So when every year they are providing us the services, they are getting entitled to more payments. When they are getting entitled to more payments, that is becoming the obligations for us. So this is what we are supposed to discuss over here. This is the current service cost for us. So the moment they are providing us the service every year, they are becoming entitled to the payment what we are supposed to give them. That means obligation is increasing every year. And this will be the expense for the company, which is expense of the current year. The benefits earned must be discounted to arrive at the present value, because we have discussed it that the obligation belongs to the future, and every year we'll be discounting it. The increase during the year in the obligation is called current service cost, which is shown as an expense, because every year they are providing as a service, they are getting entitled to one more payment, which is increasing the obligation and which is the expense of the company. So you can say the double entry to record the current service cost is debit profit or loss, because this is the expense of the current year, and credit obligation because increases the obligation every year, because once they have provided the service, they got entitled to one more payment, and that becomes the obligation. Then there is the past service cost. Now remember that the past service cost is actually something which arises due to some changes in the pension plan. Now, sorry, the changes may be for two reasons. First of all, the past service cost is the increase or decrease in the present value of the obligation. Like either you're going to increase it, but remember that this double entry which I have written over here shows the increase, because usually there will be the increase. If there is a decrease, reverse the double entry. In case of decrease, reverse the double entry. So the past service cost is the increase or decrease in the present value of the obligation resulting from, so it can be due to two reasons: the plan amendment, the introduction or withdrawal or changes to a defined benefit plan. Now say for example, now the assumptions may be changed, like you were actually giving them the 2%, now it is 2.5%. A curtailment, which is the reduction in the number of employees due to redundancy, and we'll be discussing the curtailment itself as a separate topic in IAS 19. So remember this thing that the past service cost may increase or decrease the present value of the obligation. Usually it is going to increase it, because sometimes in order to give more benefit to the employees, we are actually making the changes in the percentage we are providing to them. So when we are changing the pension plan and that results in more favorable position to the employees, that will be the expense of the company, and that is accordingly it will increase the obligation. Sometimes it goes in the favor of the organization and the pension obligation will be decreased. So we're going to reverse the double entry. Now there is a concept of the interest. So we have, in the format till now, we have discussed the service cost component. And there are two things in it you have already discussed. There is a current service cost and there is a past service cost. So the current service cost is actually the current year thing. Employees are providing as the services. When they are provided as the services, they're entitled to one more payment, which is the obligation. The past service cost is actually an adjustment. If we are only changing the plan in terms of the percentages, or we are actually changing the people in it, like, so we are making some people redundant, as a result the plan obligations will be decreased. So the past service cost is simply an adjustment, and due to that adjustment there will be the increase or decrease in the present value obligation. But the current service cost is actually a systematic increase is in the present value of obligation. So current service cost is a routine expense of the company when it comes to IAS 19. The past service cost will be due to the adjustments if they are bringing some changes into the plan. Now I'll be discussing the net service component. And remember this thing, that the working we are doing is like together the asset and the liability. So the obligation minus assets. And then we apply the net service component, net interest component. So the net interest component is this balance multiplied by the percentage. So opening balance multiplied by the percentage. Now let's discuss this thing in quite detail. It's a quite simple thing if you focus on. So we are having two things in the defined benefit. The first thing was the plan asset, and the second thing was the plan obligation. So the entity is going to put the contributions into the plan to make this amount. So this plan asset is actually the pool of resources. It has, the shares, it has the gold, it has the properties, financial instruments, many things. Like, they have maintained a pool of assets in order to make the funds available for paying to the employees. So they have the payments in the plan asset, which will produce the interest. So this interest is actually the interest income, because we are getting from the plan every year the return, which is the interest. Now the plan obligation will also result in interest, and that will be the expense. Now most of the students ask me, like, so okay, this is quite simple idea, that because in the plan asset we are receiving the interest, and that is interest income, the rate of return we are getting. But how we are getting the interest expense on the plan obligation? We have not taken any loans, so like we are having any interest. No, we have not taken any loans. But you remember the concept of unwinding, which you discussed in your F7 as well, when you were dealing with the IAS 16 and IAS 36. Now the concept of unwinding is that because we have brought the obligation to the present value, we have what we have done is, like, there was a future value, and we have brought this future value to the present value. Now accordingly, when every year is passing, we are moving further towards the future value.
So we brought the value to the present value. This concept is known as discounting. But systematically, we are taking this amount to the future value. And eventually, we are compounding it. This concept is known as the unwinding. So this unwinding is actually the interest here. You remember your IAS 16, what we were actually doing over there? We were debiting the debit asset and credit provision for dismantling. Now, every year when we were unwinding it, we were debiting the profit or loss, which was the finance cost, if you remember. We did the same thing in the contingent consideration as well when we were dealing with the consolidation in F7, and then credit provision. So this interest on the liability is actually due to the unwinding. So this is not something loan we have taken. This is the interest which is on the unwinding. So the net interest component is a net of these two things. Interest on plan asset is income. Interest on plan obligation is expense. So that is why we'll be taking the net component. If you go to the working, we are applying it on the net figure, which is the obligation minus asset. It directly gives you the net interest. But I've explained you that how this interest works. Now the contributions into the plan, these are the cash payments, so that these should be shown in the statement of the cash flows, but we'll not be showing any of these payments in the statement of profit or loss, because in the statement of profit or loss, we do not show the cash entries. The cash goes to the statement of the cash flows. Benefits paid. When you are paying the benefits, now let's go back first to the working. You see, right in front of the benefit paid, I have not shown any positive or negative figure. Why is that? The concept is simple. Or working is together of asset and liabilities. We are taking one working which is together with the assets and liabilities. So when we are paying someone from the plan, it reduces the plan asset because we are paying someone. So when you're paying, it reduces the plan asset. Similarly, when you are paying someone, it reduces the obligation as well. Like for example, if I'm supposed to pay you a money, if I owe you a money and I'm paying you from my bank account will decrease and my obligation will be reduced as well because I'm paying you. So because we are taking a combined figure, we are taking a combined figure of the assets and the liabilities. So the benefit paid will not show any movement in the working because it reduces the asset as well as the obligations. So all of these figures will be given to you in the exam. So you calculate till here and you will be given the closing balance as well. So when you compare these two figures, it will give you the remeasurement component, which will be recorded in the other comprehensive income. And now let's discuss this thing. So the simple idea, all of these defined benefit things are based on the assumptions. The actuaries are telling you the assumptions. Now their assumptions may change due to changes in the variables they are using in the market. The market is turbulent, market is dynamic, and the assumptions may change. So there will be the changes in the salaries, there will be the changes in the life expectancy, there will be the changes in the net interest component. So due to the changes, the figure will be different from what you expected. And that will give rise to the remeasurement gain or loss. This remeasurement component is actually the remeasurement gain or loss. So if it comes in the negative, it is gain. If it is positive, it is loss because we are taking the net liability working. This will be recorded in the other comprehensive income. So this is the remeasurement component, and now we can summarize it. What we are supposed to record in the profit or loss, if the examiner asks you define the treatment of the defined benefit, accounting treatment of defined benefits, you're going to tell them three things. That in the defined benefit, there will be three things. In the profit or loss, there will be the service component, current service cost and the past service cost, both was recorded as an expense. and the net interest component, which we discussed, the plan asset and the plan obligation. In the other comprehensive income, there will be the remeasurement gain or loss. In the statement of financial position, either it will be plan obligation if the plan is in deficit. If the plan is in surplus, it will be the plan assets, and then asset ceiling. And this is a concept we are going to discuss in a while. Asset ceiling. Okay, now we have the examples. Now we have the example. All right, now we have an example, and this was example number 5, I guess. The following information is provided in relation to a defined benefit plan operated by Celine. At 1st January 2004, the present value of the obligation was 140 and the fair value of the plan asset was 80. So this is the opening balance at 1st January 2004. So what is the net thing? 140 minus 80 will be the net figure. Then you have some more figures. In 20x4, the discount rate was 4%. Current and past service cost was 30 million. Benefit pays was 20. We are not going to take this thing because it does not create any impact in our working. Contributions into the plan was 25, which we are going to deduct. The present value of the obligation was 200 and the fair value of the plan asset was 120. That means again the net impact will be 80. So this is the closing balance of the 2000x4 and will become the opening balance of 20x5 as well. So then you have the interest rate in the 20x5, it was 3%, current and service cost was 32 million. And then you have the benefit paid, which is 22. We are not going to take this thing. Contribution paid is 30. And then you have again the closing balance of 20x5, which is 230 minus 140. Determine the net obligations of 20x4 and 20x5 and what should be the amount which will be taken in the profit or loss and the other comprehensive income for both years. Now this is a simple example. You just need to put this thing into this formula working. So this is the solution. Simple. You first take the opening balance of 20x4. Remember this was 140 minus 80, 60. And then you apply okay, what is the service component? The service component is 30, and then you apply the interest on the opening balance. So 4%, this was 4% in the 20x4. It gives you 2.4. The contribution is 25. All right, and then you calculate till here. You compare it, you calculate till here. And then you compare this thing with the closing balance, it gives you the remeasurement loss. Similarly, this closing balance will be the opening balance of the next year. And then again, you take the service component 32 and contribution paid minus 30 and the interest, which is again on the opening balance, which was 3% in 20x5. So it gives you you calculate till here and you compare with this and it gives you the remeasurement loss. So this was the simple calculation. You can do it yourself. I have already put the solution in your slides. Now the curtailment. Remember curtailment? Curtailment was a significant reduction in the number of employees due to the redundancies. Like now the redundancy is like when the entity is doing, for example, restructuring. And the entity is doing the restructuring or reorganization, restructuring or reorganization. So restructuring or reorganization, and due to that restructuring and reorganization, there will be a reduction, for example, reduction in the number of employees due to redundancy, because redundancy is actually something which is related to the restructuring. So what is the impact on the accounting? Any gain or loss on curtailment is the part of the service cost component. Now, remember this thing that this gain or loss is calculated, and we are going to compare two things, gain or loss. Now, there will be two things which give rise to the gain or loss. The first is actually the reduction in the obligation, and then we compare this thing with the payment we are making. Alright, the gain or loss is actually the difference between the reduction in the obligation, because when we are making the employees redundant, so we'll be making the payments to them. As a result, there will be a reduction in the plan, which is the reduction in the present value of the obligation, and the payment we are making to them. So the difference between the payment and the reduction in the obligation. And let's do an example to grip the concept. So example is Angus operates a defined benefit scheme for its employees, but has yet to record anything for the current year except to expense the cash contributions, which were 18 million. So the cash contributions were 18 million. The opening position of the net liability was 45 million, which is included in the non-current liabilities. So net obligation means assets minus liabilities, or obligations minus assets. In its draft financial statements, current year service cost was 15 million. We have discussed it. Interest rates on a good quality corporate bonds fell from 8% at the start of the year. So we are concerned regarding the start of the year figure, because we'll be applying to the opening balances. In addition, a payment of 9 million was made out of the cash of the pension scheme in relation to the employees who left the scheme. So this is the payment they have made. Reduction in the pension scheme liability as a result of curtailment was 12 million. Now this is quite clear to you. As I told you in the last slide, the gain or loss is actually the difference between the payment they are making and the reduction in the obligation. So the reduction in the obligation was 12. They are making the payment of 9. That means it is actually a gain, because they are reducing the liability by 12 and making the payment of 9. The actuary has assessed that the scheme is in deficit by 51 million as at 31st March 20x8. Now you have the data. Calculate the gain or loss on the remeasurement, which is the balancing figure we need to calculate. This is the simple answer. So the opening balance was 45, which was given in the question. You apply the opening interest rate to it. It gives you the net interest. The current service cost was 15. And the gain or curtailment, because why we are taking the gain in the brackets, because we have this working as a net obligation. That is why we are taking this figure over here in this format, in the brackets. Cash contributions was 18. So you calculate till here, and when you compare this figure to this, it gives you the loss on the remeasurement, which goes to the other comprehensive income. So let's go back to the curtailment. Any gain or loss on the curtailment is recorded as part of the service cost. Just like we record the service cost, we record the gain or loss in the same way. So we were reducing the liability by 12 and we were paying only 9. So this is 3 million gain on the curtailment, which will be recorded as a service component. Why we are recording in the brackets? Because we are making the payment of 9 and we are reducing the liability by 12. So this is the gain. Another example, AB decides to close a business segment. The segment employees will be made redundant and will earn no further pension benefits after being made redundant. Their plan asset will remain in the scheme so that the employees will be paid a pension when they reach retirement age. This is the curtailment without settlement. Before the curtailment, the scheme asset had a fair value of 500,000 and the defined benefit obligation was 600,000. It is estimated that the curtailment will reduce the present value by 10%. So 6 lakh into 10%, that means 60,000, which reflects the fact that employees will not benefit from future salary increases. Now their thing with the company is going to end. and therefore we're entitled to a smaller pension than previously estimated. What is the net gain or loss on the curtailment? So this is the simple question. The obligation is reduced by 60, and in this example they are not making any payment yet, because it is written that their plan asset will remain in the scheme so that the employees will be paid pension when they reach retirement, but they will not be getting any benefit in terms of increase in the salaries from this stage. So they are not making any payment yet. So as I told you, the gain or loss is the difference between the payment. Is there any payment? No, they are not making any payment, and the reduction in the obligation. So the reduction in the obligation is 60,000. So this will be recorded as a gain. So this is the recorded as gain, and the liability will be 540 now, because it was 600,000 and now it remains 90%, so it is 5,40,000. All right, now we have the settlement. A settlement is a simple thing when, for example, the employees are moving from the organization. There are two situations: either we are paying them or we are transferring their plan to the new employer. So again, the gain or loss on settlement comprises the difference between the fair value of the plan asset paid out, the payment which we are making, and the reduction in the present value. This is the same as curtailment. So what are we going to do when employees are leaving? We are either paying them or we are transferring their plan to the new employer. So the payment we are making and the liability we are decreasing, we will compare these two things, and the gain or loss will be recorded in the profit or loss. Now we have the concept of asset ceiling, which I told you that we will be discussing. This is a simple concept. Now, first of all, as I told you that in most of the cases you will be having in IAS 19, the plan is going to be in the deficit. So that means that is the plan obligation. Most of the times the plan is going to be in the deficit, but sometimes your plan may be in the surplus. Sometimes your plan may be in the surplus, and when it is surplus, you are going to record the plan asset. But there is a limitation placed by the standard, which is known as the asset ceiling. Now, what is this limitation? Now, the general calculation is that you compare the plan asset, the fair value of the plan asset, with the present value of the plan obligation. And if the plan asset is more than the plan obligation, then it gives you the surplus. Now, this is the surplus, which is going to be recorded as an asset. But the standard is placing a limitation and is saying that when you have the surplus, it is going to be recorded at lower of the amount calculated as normal, which is this amount, and the total of the present value of economic benefits available in the form of refunds from the plan or reduction in the future contributions. Now, the first thing is this amount clearly. Fair value of the plan asset minus the present value of the obligation, it gives you the amount which is the surplus. Now, let me explain you this second thing, what is this thing? When your plan is in surplus, now that means you have two choices. This is your plan asset and this is in the surplus, and you are maintaining the plan asset in order to meet your plan obligation, and you do not have any other business objective from it. You are not going to earn anything out of it. You are just maintaining the plan asset in order to meet the plan obligations. But what if your plan is in surplus? Now you have two choices. When your plan is in surplus, you have two choices. The first choice is that you actually withdraw some money from the plan. This is the first choice. The second choice is that you stop your contributions for some time. So when your plan is in the surplus, either you will be taking out some money out of the plan, which is the withdrawal, or the second thing is you will be stopping your contributions for some time so that the plan asset actually gets equal to the plan obligation, because there is no other benefit from it. So the standard says that when you have the plan in the surplus, you record the amount which is lower of the normal calculation, which is this amount over here, and this is the second amount. Whether you are taking out some money or you are stopping your contributions, so you take the lower of these two amounts. And it means that the surplus can only be recognized to the extent that it is recoverable from the refunds or reduced contributions in the future. Now let's take an example and then you will quickly get it. The following information relates to a defined benefit plan. The fair value of the plan assets is 950 and the present value of the pension liability is 800. So that means your plan is in surplus. 850, 950 minus 800 gives you 150. The present value of the future refunds and reduction in the future contribution is 70. So you are taking 70 out of it. What is the value of the asset to be recognized? So the normal calculation is 150 and the benefit you are getting from the plan is 70. So you should record lower of. That means your asset will be recorded at 70 rather than 150. Now you have the termination benefits. As I told you at the start of the IAS 19, IAS 19 discussed four types of benefits, four types of employee benefits. The first we discussed the short-term benefits. We discussed the short-term absences as well. Then we discussed the post-employment, which includes the defined contribution and the defined benefit. Now we are discussing the termination benefits. Now the termination benefit, as I gave you the example at the start of the lecture, like for example, you are letting your employees go earlier than what they were supposed to go, and you're making payment for that. Like for example, they were supposed to retire after 5 years, but you say if you go now, we'll be making you this payment. This is the termination benefit. So whenever that arises, they will be recording the payment in the period in which that arises. Like for example, if I have the employees and I tell them now that if you leave by this year, we'll be paying you this much amount. So we'll be recording the expense in the current year. Then you have the other long-term employee benefits, such as I gave you the example that long-term leaves and like the employees are not coming to the organization, they are not serving the organization, but they are getting the pay for it. So long-term benefit should be recorded as a long-term liability, as the name suggests. Then you have the disclosure requirements. Read it yourself that in the notes of the financial statement, what things we'll be disclosing as per IAS 19. So the assumptions will be disclosing general description of the plan, whether it is defined benefit or the defined contribution, the reconciliations, and then what should be charged to the other comprehensive income, and then blah, blah, blah. So these are the disclosure requirements. So this was IAS 19, a very, very important standard, and hopefully you have understood it. Now in the next video, you will be looking at the questions from my question bank, and hopefully you have understood the standard in a quite detailed way. Take care.